Ackerman Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Ackerman's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at ackermanresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. He's speaking to us from South Florida. Welcome back to the show, Rick.
Thanks much for inviting me on, Jim. Always a pleasure.
Rick, a lot of people surprised that the NASDAQ had a major falling off, at least at the time that we're speaking on Tuesday. No shock to you?
No shock. I put out something Sunday night that mentioned that we had an interesting coincidence. There's an index called, symbol is IWM, and it tracks the small cap stocks of the Russell 2000. And it had formed over the last couple of months a beautiful head and shoulders pattern, a very bearish chart pattern. And even though I don't pay much attention to those patterns because they're everywhere you want to see them, this one was too pretty to ignore. So at the same time, the E-mini S&Ps, which track the S&P 500 by way of a futures contract, were topping at what I call the secondary pivot of a big pattern, but also a much larger pattern extending all the way back to 2019. It was at this secondary pivot. And when trends fail, whether you're talking about stocks or futures, ETFs, whatever, when they fail very precisely at that P2 secondary pivot, they have a way of turning nasty. You know, the corrections can get pretty vicious, technically even to the point where they take out the point C low of these ABCD patterns that I use. So I did put that out Sunday, just in a little bit tongue-in-cheek. I told my readers, the perma-bears anyway, that I was going to titillate them with that news of this technical coincidence I just described, but they shouldn't take it too seriously because this stock market has essentially blasted its way free from such predicaments ever since 2009. So we don't want to bet too heavily that we've actually hit the mother of all tops, and I don't think we have actually. This could be a pretty wicked correction, but I think we've got higher numbers, specifically 4, 5, 3, 6 on the S&Ps as opposed to this failure here at around 4,200.
So a correction. How big a correction, and then more marching to the top and more record highs?
Well, as I said, when trends fail, they trace out this ABCD pattern, and 25% of the way along the way of the CD leg is where you get in, and P, the midpoint pivot, halfway to the D target, is a frequent trend reversal place. But once you pop through that, you have good odds of getting to D, and we've done that, but you're always looking out for that stall at P2, the secondary pivot, which is midway between the midpoint of your CD leg and the D target. So that's exactly where we were, but I have I wouldn't call it conflicting evidence. I would say that once we get done a correction here, however serious it is, we will go on to new highs.
Do the major traders look for things like this? Because, of course, so many people are into speculation mania right now. Perhaps they're not looking at details the way you do.
Well, I think technical analysis is the only way to approach it, because if you try to look at these markets rationally and extrapolate value, you don't have it. The prices are so ridiculous. They're beyond insane, really. I think that it's not just that chimpanzees are trading the market, guys that simply have the responsibility of taking effectively unlimited quantities of other people's money and throwing it at whatever the theme of the month is. You just have buying from other sources. Apple just announced that it was buying $50 billion more worth of its own shares. So the money to push these stocks higher seems unlimited, and they've lost their moorings. Really, they've broken free of any rational valuation that you could calculate. So I find far and away the best way to look at them is just to simply look at the charts and do price projections into the irrational ether.
Now, there was just a major purchase, I think, of AOL, something that a lot of people don't use anymore. $5 billion thrown into that. Is this a case of people have all this cash sloshing around and they're just looking to throw it out at just about anything?
Yeah, I mean, it's got to go somewhere. And that's why I the last few conversations we've had, actually going back a ways, I like the stuff nobody likes. And gold and bonds seem to me the place to be. Not now. To most investors, that won't make sense. And they're thinking, geez, I'm really going to miss the party here. But obviously you have to leave the party before the police come and break everything up in order to be safe. So that's why I just think it's good to be leaning in the direction of stuff that everybody hates right now.
We'll have more with Rick Ackerman right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Ackerman, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Rick Ackerman. Rick, crude, surprisingly strong. Are you shocked by it or surprised?
Well, I think crude it's a testimony to the fraud that's floated asset values higher and higher globally. Crude simply has found a level where the producers can make some money. If crude were to go down, the whole global economy would deflate like a balloon with a nail driven through it. So crude, just based on an intensely manipulated market, is up there. I think NYMEX is trading around $66 a barrel, that we could be at a top right here, but I have to say if it blows through 66, closes above 67, 68 for a couple of days, it would suggest that crude prices could go significantly higher. But when you talk about, that is one commodity where there really is a they, and they need the price to be up, maybe even higher than it is, so that the operating margins are there. But more crucially, so that the huge number of financial instruments that get traded on a basis of oil as collateral are propped up. So crude has been magnificently manipulated. The market's a total fraud, and I think they're doing a great job.
We'll have more with Rick Ackerman right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Rick Ackerman. Rick, are hedge funds in trouble?
No. I don't think a hedge fund's ever going to be in trouble because they are very resourceful, very imaginative. They have leeway to kind of trade anything they want. And even though some of them will get on the ropes from trading that flavor of the month, whatever, and it will go suddenly, very unexpectedly, and heavily against them. They can get in trouble. But by and large, hedge funds they're maneuverable, other than the really, really big ones. So they'll be all right. But markets can be really tricky. You just don't get the kind of trends that you need for a good, profitable ride. And that's always going to be a stumbling block for the hedgies. But don't worry about them. They'll take care of themselves.
All right, so I won't have to start a GoFundMe for Anthony Scaramucci and those boys. I think his hedge fund's worth about $13 billion.
Which is really chump change when you look at some of the really big funds like BlackRock, for one. BlackRock, the numbers are so big, you think maybe they own Jeff Bezos.
Wow, that's saying something. And talking about high-tech stocks, the NASDAQ taking a hammering, are the high-techs going to come back, or was that just a case of the FANGs are in trouble, but everybody else is doing okay?
Well, the interesting thing is that the chimpanzees that invest your hard-earned money in the markets, the money managers, they're constantly rotating. It's like it's a game. And when I see today, the Dow's only off $85. It's come back a ways, 200 or 300 points from the lows, and it's barely down the industrial average. On the other hand, the E-mini S&P is getting hit harder, and the NASDAQ harder still. The NAS is off about 2.5%, whereas the Dow is off only 0.26%. So when I see that, I don't consider it a bearish divergence. I look at it as kind of the opposite, that the chimpanzees that are running the show have enough control that they met in that smoke-filled room this morning, and they said, okay, guys, these NAS stocks are looking a little pricey. Let's let them fall so we can buy them cheap again. And they're doing that, and that means that they don't have to sell everything. So the Dow is getting supported today while the NASDAQ falls, and overall that gives you a picture of control, of manipulation.
Janet Yellen, the head of the Treasury Department, says interest rates are going to go up at some point. Is that something that she controls, or are there market forces at work? And really, central banks like to say they're in control, but they're really not.
Well, I have to say I've tuned that little munchkin out so completely, I never hear anything she says. If I see the word Yellen in a headline, I don't even read any further than her name. And, cause she has nothing of value, to say to anybody. You have to realize that the whole, the job of the Treasury and Federal Reserve is to quote unquote manage our expectations. So whatever they say is just spin. And, if she says interest rates are going to rise at some point, that's not really, that's not Einstein speaking, it's, so it's like, so what? What's that mean? It means nothing. So I don't really pay much attention, but you do know that I'm on the deflationist side of, I don't even consider it an argument. I think that anybody who thinks we're going to inflate our way out of the hole, they just don't understand the situation. That's not to say that we're not having inflation at the consumer level now. A lot of things, the prices are going up, but in some cases they've kind of stagnated. They've hit a wall, and that's true for a couple of what I would call intractable engines of inflation. One of them is college education. Well, people are wised up to the fact that it's a total waste of money to send your kid to college anymore, outside of the sciences and math and engineering. But to get them an Ivy League degree for $250,000, actually, no, it costs quite a bit more than that. I think, when you're talking, tuition, room and board at some of your better schools, $250,000 is just a starting point. So the colleges, I don't think, are going to be able to forever raise the price. Certainly the $1.7 trillion that was borrowed on student loans has helped inflate college costs. But so some of the real engines of inflation are breaking down now, and even though we still have inflation from all the stimulus, the bigger picture is of a whole asset structure that's supported. It's a lot of hot air. So I can only see an implosion of the financial assets, and of course that's very different from the inflation we had in the 70s. You know, the experts keep conflating consumer price inflation, pushed by higher wage demands and things like that we're never even going to see here. And we don't have that kind of organic inflation. But what we've got is an inflation that could bust, that could break, that could implode tomorrow if the stock market came down hard. So it's a very different kind of inflation, even though people who talk about all this inflation we're going to have are deliberately confusing the definition of it. You know, they're sort of thinking back to the 70s type inflation that we cannot have, that we will not have. And, but the deflation part of it is simply, the inevitable collapse in asset values that's coming. Financial assets I'm talking about, and of course real estate.
I was going to ask about real estate. It seems insane right now, the kind of prices people are willing to pay for absolute junk.
Yeah, and that's telling you something. I mean, that's been going on for so long. You know, you look in Southern California where these little 1,100 square foot ranchers are trading for upwards of $600,000. You know, you're right. When you look at it, you think, well, it just ain't worth it. Well, that's what everybody's paying. But it's only because the banks will lend them. Nobody buys that home anymore thinking they're going to own it. They're just going to make payments on it until they can sell it for a higher price and trade up to the next level that they can't afford. So, you know, but your instincts aren't wrong. When you look at an 1,100 square foot home and it's owned not by some millionaire, it's owned by a working stiff like you and I, there's only one conclusion. The house is insanely overpriced, and the price has to come down. I mean, there are 100 reasons why, but you could start anywhere. You could say, well, are all these millennials who are coming out of college with their art history degrees, are they going to eventually be able to buy those homes from the baby boomers when the baby boomers downsize? So yeah, housing prices are headed into a collapse that has been obvious for 50 years. And we got halfway there in the 7-8 collapse. And I've always thought that home prices were going to come down at least 70%. We got halfway there. And I think vacation homes, second homes, are going to get hit a lot worse. That there'll be a 90% collapse in those prices. But not right now. I mean, we're in the heat of this frenzy, and even the price of new homes for once finally went above old homes just because lumber prices are way up, and you know, you have inflated costs to build a house. But we're headed into something disastrous with home prices in general.
Rick, thank you so much for chatting with us.
Always a pleasure, Jim. I hope I didn't scare anyone away.
Well, if we're not scaring people, we're not doing our job. Isn't that the slogan of most newsrooms?
I guess so. Or comfort the afflicted and afflict the comfortable.
Rick, thanks again.
Thank you, Jim.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He was speaking to us from South Florida. If you have any questions for Rick or any of our other guests, you can send them to info@howestreet.com. Our Twitter handle @HowStreet. Our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.